Hello, everyone, and welcome to our seminar on preparing the parochial report. I'm really glad that you're here. Um, we are going to have the presentation, and then we're going to switch to Q&A. So in order to do Q&A, you'll need to put your questions in the Q&A box. Don't put them in chat because there will be more than one place we'll have to look. So make sure you put them in the Q&A. But before we start, I'm having a problem opening up the Spanish speaking room. Miguel is our Spanish interpreter, and I'm wondering, could you put in the Q&A box if you need Spanish interpretation? And then we're going to improvise. So let me just give it a second. So just put in the Q&A box, I need Spanish interpretation. Okay, nobody has put it in. If by some chance somebody does require it, we've already done a session earlier. We did one at noon. It's recorded and it has the Spanish interpretation. So I'm sorry for that glitch. I have to be educated on how to activate the interpretation piece. So anyway, so we're going to look at the Procure reports. Just a reminder that the Procure reports are it's a document that the Episcopal Church has developed to get data for their massive data computations. So the Procure report is not actually, it's not actually designed for congregations, for dioceses to do Procure reports. The diocese, I'm sorry, assessment calculations. Dioceses throughout the United States, well, dioceses throughout the Episcopal Church have used data from the Procure reports to use as their starting point for assessment calculations. And almost every diocese uses the net operating income number. Unfortunately, when they decided to make the revisions, they didn't have a net operating income number. So there's a workaround, and we are going to get to the same place. So please don't stress over this. I can tell you that the Episcopal Church at large has been very stressed over this. I belong to a listserv, and the questions that are coming in regarding this are just blowing it up. So we're going to get there. And let me start sharing the screen. Okay. So the way this is going to be structured is I'm going to basically go over the preparation of the Parochial report. Then we're going to touch on how we'll calculate the assessment, and then we'll open up for Q&A. So to begin with, this is different this year. The deadline is different this year in that it's a hard deadline. Usually the deadline is March 1st, but it's kind of a soft deadline. And people can still submit their Procure reports after March 1st, and I can still review them and send them on to the Episcopal Church. But they have really tightened this down, and March 1st is a hard deadline. On March 1st at 11:59 p.m., they are going to lock the system. So if you haven't filed your parochial report, you're going to have to send all of your data to me, and I'm going to have to input all of the information and send it on. So please don't do that. Please make sure you get your report done on time. And if you have any problems, email me and I will help you. Okay, let's look at how they're collecting data for the revenue side. And you can see this is very different. And I will say in advance of starting this piece that many people are looking at this and they're going, oh my goodness, this A is confusing. B, what box are you going to use for the assessments? And the answer is we're not using revenue. Okay, so just look at this and let's make sure that we're putting the right numbers in the right boxes. And the other thing to remember is that this is not a financial statement. This is data that the Episcopal Church wants. So in some instances, you will have numbers on your P&L statement, on your expense statement, your income statement, or your expense statement that will not end up in the Proker report. And we're going to talk about one key one in a minute when we get there. So the first box for income is box 3, plate offerings, pledge payments, and regular support. This one is pretty self-evident. So basically, if you receive it in a plate through the mail electronically, and it is undesignated, it's going to be used for operations, it's not restricted, it goes in that box. So things that wouldn't go in there that may end up in your offering plate would be contributions to the clergy discretionary fund, or they could be items that the donor has designated for a specific reason, for a specific use. So an example of that would be, any capital type of contributions, one's for a building campaign, one's for, even for altar flowers, you get Easter lilies. So that would not go in there. It's going to go in a different box. So let's look at the second box. So the second box are contributions restricted by contributors for specific uses. So basically, if somebody makes a contribution to an endowment fund, capital campaign, or any other kind of restricted donation, it will not go in. I mean, it goes in this box. So what is not included in this box would be fundraisers, grants, if you've got a thrift shop or you have a Christmas bazaar or something similar to that, or rent income. So those items will not go in that box. It's basically for specifically designated items. The next box, box 5, is going to pick up some of those. So what's included in this one, which is called all other revenue, are gross sales. So if you sell something, it's going to go in there. Gross rental income. So gross means that it doesn't have the expenses netted against it. So if you earn $10,000 a year to rent out your kitchen and it costs you $1,000 in supplies or electricity, you will record the full $10,000 here. Now remember, this is not an assessment calculation, so don't sweat that. We just need to fill it out and give them the data that they want. Fundraising activities, if you have a big fundraiser, you're going to put that in there, but that also is a gross number. It's not a net number. So the expenses that you have incurred to do the fundraising are not netted against this number. Income draws from endowments and other investments. Okay, this one is a little bit confusing, but we can ferret this out. So what this basically is, say like you get interest, dividends, capital gains, and you pull those out from your investments. Okay, that is going to go in this box. If you take like a 4.5%, 5% draw from your endowment, the whole purpose of using that particular percentage is so that you don't invade the corpus of your investment. And in theory, you're drawing only income out of it. So if your investment earned a 6%, earned 6% during the year, and you pull out up to 6%, then that number goes in here in this box. If, however, you've got a big project and you're pulling out a big number and you're invading your corpus, you're reducing your asset, then that number does not go in here. You've already included it in another box, so it doesn't go in here. So it's only the income from your investments. Would also include interest income, which is just from your cash account or your savings or your CDs, and grants. Things that are not included in this box would be the gains and sales, losses from the sale of investments. So you've got an investment in stock, you sell it for $10,000, you paid $5,000, you have a gain of $5,000, that does not go in here. Unrealized gains or losses. So those are the gains or losses that you see on your brokerage statement or on your report at the end of the year, where it says, oh, my stock has appreciated. That's unrealized because you didn't sell the asset. Likewise, if your asset decreases in value, you invested $10,000 and now it's worth $8,000, you have an unrealized loss of $2,000. It's unrealized because you haven't sold the asset. So neither of those numbers go in this box. Rental expenses do not go in this box. There's another place to record them. And expenses associated with fundraising do not go in this box. So now with expenses, they've basically put these into two categories. One category is church non-capital expenses, and the other is church capital expenses. So this one is basically going to be everything or almost everything that's not capital. So some of the things that are included in this would be your operating expenses, such as your salaries, your insurance, your utilities, all those things that it takes to operate your congregation. It also is going to include small purchases like computers and cell phones. Those will not go in capital. It will include outreach expenses. The outreach expenses that are not included in your operating budget are included in this scenario, okay? They didn't used to be in there. They used to be in a separate category, a separate box. So in this box, box 6, you're going to have outreach that's on in your operating budget. And then you're going to have the outreach expenses that are not on your operating budget. And so how does that happen? Well, some congregations have a large outreach ministry aside from the normal workings of the church. So for example, if they have a food pantry or a laundry service, something like that, they oftentimes will take it out of the operating budget and it'll have its own accounting. So in this instance, those numbers will be in this box. Those expenses will be. It's also going to include your assessments, contributions that you make to other organizations. So say like you write a check to ERD, that will be included in here. And it will include property maintenance. And that means it's things like plumbing repair. Your toilet gets backed up, you call a plumber, they come out and repair it. You have a broken window, you repair it, that goes in there. And it also includes painting. And this is something we get a lot of questions on. Even if you paint your whole church and it costs a lot of money, I get that. It is a maintenance expense. And the accounting reason why it is maintenance is because repainting your church does not extend the useful life of your church. So the dollar amount doesn't matter. What matters is this extending the useful life. If, however, you put a new roof on, that does extend the useful life of the church. And this is all by definition, this is all GAAP. I'm not making this stuff up, but that's kind of the rule. So just to keep in mind the things that go in this non-capital expenses versus things that don't. Also, what's not included are fundraising expenses. And fundraising expenses really don't have a home. I've attended every webinar, I've looked every place, and it does not appear to be classified in either of these categories. So, and again, this is not a financial statement. This is data that the Episcopal Church wants. If you do a building addition or a major renovation, those costs are not included in this box. Or if you purchase an appliance or a copy machine, those are not included in this box. So let's look what is included in the capital expenses. So in here, this is basically major capital type improvements. So if you decide to convert your upstairs into a rectory, all of those expenses are included here. If you renovate your church kitchen, those expenses are included here. If you purchase a new stove or refrigerator or copy machine, and they're going to have a useful life of many years. And so those are included in here. So what's not included would be the smaller things, computers, which we already said were going to be in the other box, cell phones. If you buy a television, because you want to have a group Zoom meeting, et cetera, that will go in there, and building maintenance. So that's basically the revenue and expenses on this new report. Then they also have a box that they want you to put your cash, checking, and savings balances in. So this one is pretty straightforward. So this, of course, is not going to include your endowment. It's not going to include like a brokerage account if you have one on the side. It's not going to include the DFMS investment if you have that through the diocese. So endowments and investments has an expanded reporting here. So basically what they want you to do is put your endowments, if they're restricted, in one box under 9A, and non-endowed investments in on the right-hand side. So the difference between an endowment and a non-endowed investment is that endowments are donated by a person. A non-endowed investment is one in which the church has additional funds and they invest it on their own. Could be one that, you know, you have a fundraiser and you want to use it for X, Y, or Z, then that would be a non-endowed investment, or the vestry designates money to put into this type of investment. That's where it goes. So that's the difference between the two. And the difference between restricted and unrestricted is that in restricted investments are restricted for a particular use by the donor. They're not restricted by a vestry or bishop's committee. They're restricted by the donor. And so that's just a definition that's included in accounting. And this particular area will add all the figures by itself. So that's really helpful. Then they want to know on line 9C, what was the dollar amount that you drew out from these investments? And then once you have that number, you can compute the percentage draw just by doing easy math computation, and you can put that on line 9B. So line 9D is a little bit more complicated because this is where they're going to want you to put your unrealized and realized gain losses. You're going to put that in there. And if you go down to example E continued, they have an excellent example, because what also gets included in this line would be dividends, interest payments. So even if you have interest from your cash account, you'll put that amount there. If you sell a stock or an investment, that goes in there. Unrealized gains or losses goes in there. And then you can net out any fees that you pay for brokerage service or account management. And so this example, I think, is very helpful in order to come up with that number. So that's something that's really new this year. So let's talk about assessments for just a minute, because I know that this is something that's of great concern for people, because you look at this report and you go, okay, this is really different. So like, how is this going to impact the assessment? Am I going to have the same starting place? And so the answer to this is yes, we're going to get to that same starting place. So here is the assessment formula. And the reason it says proposed is because I grabbed this from the convention booklet. And so, but this was approved by convention, so this is what it is. But basically, what we always have done is we take the amount on line A, which is net operating income. All right, so something to keep in mind, because we want to be consistent. Why did I do this? Okay. We want to get to the same starting place as we have before. So we always use net operating income or net operating expenses. Those two numbers should be equal. So as long as we can get to one or the other, then we have the same starting place that we've always had on our assessment computation. But as you look at the income numbers here, you can see that, oh, that's not what I want to do. If you look at the income numbers on here, oh, I'm sorry, second. There's no way that we can use any of these boxes to get to the starting place. It just doesn't work because they're collecting information for different purposes. So what we're going to do is we're going to turn to expenses. Now keep in mind, net operating income equals net operating expenses. So we're going to look at the expense side to get to that same number. So the church non-capital expenses number is a close number, but it still has some items in there that we don't want to start out, right? So we're going to back those out. So in the old broker report, we can see that our operating expenses included the amount that we paid in assessments, outreach that was in the operating budget, and all other operating expenses, your salaries, any rent expense, insurance, blah, blah, blah. The non-operating expenses included the major improvements and capital expenditures. Well, that line item is already in a different place. That line is now in the church capital expenses box. So we don't have to worry about that one. But the last three numbers, the expenses for congregations outreach and mission, that's if you have a separate outreach, and funds that you give to seminaries or other organizations, those numbers are now included in the church non-capital expenses. So we have to back those out. So what we've done is at the bottom of the additional financial information tab, there's a place for you to go, and it says your diocese has provided a form for submitting additional information. So you click there and this black box comes up, and then you click that to gain access. And then what happens is this questionnaire comes up. This questionnaire is our internal questionnaire, and it's completely different software than what the Episcopal Church is using. The Episcopal Church doesn't even get this form. It comes directly to us. And that's the reason why you have to be redundant and put your congregation name, because if you don't, I don't know who's sending it. I don't know what congregation to subtract out these amounts. And I also asked for the address because we have several instances of congregations with the same name, like, a St. John's, for example. And I want to make sure that I have the correct one. So at the bottom of this, what we've done is, okay, we need to back out of that one expense number, the two items that don't belong there, because we want to get to the same starting place as before. So here's a line item for you to put your outreach expenses that are not included in the operating budget. So that's a big one. That's the one that you don't have in your operating budget. It's separate. Perhaps that's a laundry lift. Perhaps it's a food kitchen. Perhaps it is, a food distribution service. So that's where you will put that number. And then on the second line, you're going to drop in the funds sent to other organizations. So that would be like the ones that you write the check for ERD, or you send money to a seminary. So those numbers go there. And so with those two adjustments, I'll put those on a spreadsheet and I'll subtract those out of your church non-capital expenses. And we will be at the same place as we've always been before to start out. Okay, so at this point, I want to open this up to some questions. Let me get the Q&A. How is endowment different from a specified donation? Okay, so a specified donation or restricted donation can be one that just goes to like your altar lily, Easter lily account. It could be something that is specific for like the rector's discretionary fund. So those are completely different, and those are included in your operating budget. An endowment is a pool of money, an investment that has been given by a person so that the funds will be held in perpetuity usually, and you will be able to draw the income from that for a specific reason. And that specific reason is oftentimes determined by the donor, and sometimes not. Sometimes it's unrestricted. All right. We use our investment account for liquidity management with funds going in and out as needed. How do I figure our draw? So I have to have a clarifying question here. Um, is your investment account, like, are you buying and selling stocks, or is this investment like a high yield savings account? So, if it's a high yield savings account, you can draw money out of that without including it in, I think you can do that. I think you can do that without including it on that other supplemental page. If you're pulling it out of, if you're buying and selling stocks, or you're pulling it out of an an endowment or non-endowed fund, then you would put it in that box, the one that's on that with the supplemental information, the 9 that has all the detailed information. So I hope that that makes sense. If it doesn't, you can either pop in a clarifying question or send me an email. Will these slides be sent out? No, they won't. This program that I use for these slides does not send out very well, but we are posting it on the website, and it will be the one that we did at noon, and we'll also have it translated. So they'll be available for you to go back to at any time. And again, call me anytime. Can outreach expenses include expenses for a fundraiser in which the funds raised are to be used for outreach? Can outreach expenses include expenses for a fundraiser? Okay, so outreach expenses, that it doesn't matter where you get the where you pull your outreach expenses from. I'm not sure if you're asking is it the expenses that were incurred for doing the fundraiser. So like if it cost you money to do the fundraiser, that's not going to be included. But if you are fundraising and you use it for outreach, then it's going to be in the outreach expense. I hope that makes sense. Okay, let me pull down. Oh, CDs. Yeah. I almost forgot your question. No, you can pull those out. And you don't have to, I don't think you have to drop it in that section 9. Are expenses related to rental income excluded from? Yeah, so the rental expenses don't go there. So what you're going to do is there is another line item on the Proker report where it asks about the rental details. So that's where you're going to drop those. So those do not go in those expense boxes at all. Oh, Leslie, sorry. I'll email you. Okay, please do. I'm sorry. Our expenses. Okay, we did that one. Okay. Do we have any other questions? No? Okay. Well, thank you so much for joining us. I hope this was helpful. Please feel free to email me at any time with questions. Okay. So thank you very much. Have a super good evening.